Hello and welcome to everybody who's joined. Let's give it a minute or two and we shall commence. Hello and welcome to the first in our series of insurance pricing webinars. My name's Stephen Kennedy and I head up insurance pricing at Pearson Ham. Pearson Ham is a pricing consultancy working across multiple sectors. We operate in retail, restaurants, cinema, veterinary care, life sciences. Essentially, if there's a price associated with it, and then we can get involved and help out with that. Insurance is probably about 20 to 25% of the business, and I've been helping to grow that side for the past couple of years that I've been with Pearson Ham. Prior to that, I was heading up pricing for Hastings Direct, and I established the retail pricing function there in 2009 and developed that over the course of the next 8 years to 2017. My background is retail pricing. So prior to Hastings, I was pricing at Superdrug, and before that, Shell non-fuel retailing, so the select shop side of things. So from sandwiches, crisps and Mars bars to health and beauty products to insurance policies, and really applying the same types of retail pricing techniques and processes to insurance and helping to really drive the business forward through doing that. Today, I'd like to talk about the impact of the coronavirus pandemic on UK motor insurance pricing, the opportunities and challenges that have been presented by that, and the uncertainty that has arisen because of the situation we found ourselves in, and really how the industry has reacted and some of the activities that we've observed over the past few months as we've been in this very strange situation. So I'm going to go through that initially. Please, if you have any questions, then feel free to send them through using the chat function, and I'll endeavour to answer as many as I can at the end of the presentation. So the insurance industry is predicated on risk, and it's what underpins the entire industry, and being able to assess risk and determine risk more effectively is what sets aside the successful insurance companies from the rest. It's what really gives the competitive edge, and it relies on a certain level of confidence and certainty in being able to assess risk and predict the likelihood of claims and other impacts. So when we find ourselves in a situation like this, it's something that's very unprecedented and difficult to try and predict what's going to happen and what the effects might be. So in February, while we were still trying to work out the best way to deal with Storm Kira and Storm Dennis, we heard news from China about a virus that was spreading rapidly. A global pandemic went from a possibility to a reality very quickly, and certainly a very unprecedented reality. So it's something which there's no historic data to look back to see, well, how is this going to impact and how should we respond to it? So one of the first things we see is business continuity plans kicking in. In insurance, this generally means dealing with existing customers, making sure that you're providing good levels of service and that claims are being managed effectively. The challenge here is how to balance that with the volume of new business coming in, and often there's a need to reduce that volume of new business in order to be able to focus on your existing customers. An additional challenge that we saw at this time was having to move our core staff, so our colleagues who are focused on delivering that level of service and making sure that existing customers are being looked after, from this scenario where they are well structured and well managed call center staff to this, so working from home. On the 16th of March, the Prime Minister said that everybody who could should be working from home. We went into a period of lockdown. So this creates challenges in terms of being able to manage and provide good levels of customer service, and also puts an additional importance on being able to manage the stem the flow of new business coming in. So this could mean high prices. So in order to be able to do that and manage things effectively in terms of customer service and claims, we may expect to see price increases coming into the market, and we would expect that to happen relatively quickly. In reality, we've seen a number of different strategies playing out in this area. So where companies have been agile enough and able to make price changes very quickly, we have seen some of this happening, but there are also other considerations to think about. So in terms of pricing and driver behaviour and activity and how that's being impacted by the events that are unfolding and the lockdown that we found ourselves in, and how the business continuity plans are supported by the pricing action that's being taken. At Pearson Ham, we have a panel of consumers who we use to run quotes through the big four price comparison sites to be able to monitor and track price movements. So this differs from some of the other price indices we see in the market, in that it's the same profiles, the same individuals whose prices we are tracking, so we can see actual price changes which wouldn't be driven by impacts on mix change or the structure of the quotes coming in being different because of external factors impacting them. So what did we see? So following the World Health Organization's declaration of the pandemic, we did see some insurers raising prices. Overall, the average price movement between the periods of the middle of February to the end of April appeared relatively flat, but there was a lot of activity going on underneath that. So in terms of what we're seeing here, the orange insurer, Insurer 3, increased prices following that declaration, as did Insurer 1 on the dark green line. And we notice Insurer 3 now, sort of, as business continuity plans play out, as people have been moved from working in the call centre to working at home, as that's proving to be effective, as the levels of customer service are being achieved, then it's possible to open up some of the gates again and let some new business flow through. So it would appear very much that Insurer 3 has been able to react and respond very quickly, get service levels to a place where they want them, have confidence in the business as it is, and be able to try and get some more of that business back and claw back some of the volumes that were lost over the past few weeks. Now, the kind of blanket price increases is a way of doing this, but most insurers, where possible, should be looking at targeted reductions to be able to manage the flow of business, or differences in quotability. So to be able to focus on the best and most attractive customers for you. This is the same time period, a slightly different axis, but it's the same period for some other insurers. So those who are less quick to respond, we've seen, have waited until the lockdown kicked in fully in the UK. And from there, we've seen quite significant price increases coming in, and they've been maintained. So the behaviour that we've seen has varied, and it's been quite different depending on the insurer that we've been looking at. So prices have come down, where we're looking at prices increasing initially to manage that flow of business. We've then seen reductions in the market, and there are other factors which are influencing some of the price moves that we've been seeing. One of the considerations is customer mileage. So during lockdown, obviously, people have not been able to travel to the same extent that they would have done previously. So we are restricted to essential journeys only. So people are working from home, there's no commuting, people aren't going out for leisure, and the mileage has dropped off significantly. There's an obvious impact in terms of exposure to risk here. So the prices that people have paid for their premiums relate to the mileage that they expected to do. So when they ran the original quotation, if they expected to do 10,000 miles, then they've been priced based on that risk. Obviously, if your mileage has reduced significantly, then the cost of covering that risk, again, has come down quite significantly. So there is a margin benefit to insurers through the lockdown that we found ourselves in, and a potential to look at re-rating and readjusting some of those pricing models based on reality being different from original expectations. So where we expected somebody to do 10,000 miles, actually in reality they're going to be doing less than 1,000, then do we want to look at reassessing the pricing models, and with this factor to be included in it, and to make some judgment-based changes to be able to more accurately reflect the current climate and what's happening in terms of driving behaviour. There are other ways of dealing with it. So you can keep the margin, you can invest in prices, you can make them more appropriate to what you think. And we've seen a number of different strategies playing out in this area. One of the most notable is Admiral. So I think there was quite a bit of publicity around this at the time. So offering refunds of £25 to cover 4.4 million vehicles due to the reduced exposure and change in driving behaviours. This followed similar actions by insurers in the States and in Europe, and has been followed here by LV in a more limited way, with a few more hoops for the customers to have to go through in order to claim that money back. But it's certainly a very interesting approach, and I think that the time will tell how effective an investment that is. So £110 million is a lot of money to invest, and we need to be able to see, do we get the return in goodwill and the consequent positive impact on retention rates and conversion rates based on this. And there was certainly a lot of pressure from the press around what should be done here, and pushing insurers to give that refund. And it will be interesting to see how that plays out. Mix has also been impacted. So there are opportunities and challenges that are presented in terms of driver mix. So there are a reduced number of new younger drivers coming into the market as driving tests have been postponed and stalled, and that has impacted the mix of quotations coming in. New vehicle sales also dropped off a cliff. So again, we're seeing that reduced in terms of the mix of quotes coming in. So younger drivers have fallen out, new drivers have fallen out, new vehicles are out. So the entire mix of quotes coming in that insurers are pricing and have been over the past few months has been changing. And I think this is something which insurers need to be looking at in terms of assessing where they are in terms of pricing for those particular factors. Are there measures that they should be taking? Should they be reassessing where they are with those things? Looking at applying judgment to where do we expect the reality to be? The pricing models are based on historic activity and what has been expected. So we're expecting a certain level of risk. However, there's now a level of uncertainty, and there's certainly been a lot of changes in terms of the mix and the risk that represents. So what can be done to try and respond and react to that? And how do we reassess our pricing models to make them more appropriate for the situation that we now find ourselves in? We've also seen an increased interest in propositions such as buy miles, so the pay per drive proposition, and also insurers now have been accelerating plans to develop similar propositions. So I think there are opportunities in the current environment for developing of those new propositions, whether it's pay per mile, whether it's fixed term, longer term policies. If we feel that we're in a market where prices are fluctuating and maybe moving downwards, then there may be an opportunity to do that. So I mentioned market moving downwards, and I'm showing some market indices here for Q2 of this year, and we can see that they're all showing downward movements of varying degrees. And I think that some of the differences observed here are in the methodologies, and the average premiums are kind of indicative of the batches that are used to calculate these. So Money Supermarket, Confused, and Pearson Ham. Money Supermarket and Confused, obviously the comparison sites who are looking at quotes over the period, which can tend to be influenced by the kind of mixed movements more than Pearson Ham, where we are looking at the same batch of risk profiles and how prices have actually changed for them. So average premiums are varying greatly between the three, so from 770 on Confused to 325 on Pearson Ham, and that's reflective of the profile of the batches that are being run through. So we can see there is downward movement being reported for all of them, some larger than others. So the 4.8% reduction from Confused, which may be more driven by the kind of change in mix that's been seen over the past couple of months. We are seeing market predictions for continued downward movements from the aggregators. However, when we look at our profiles that are being run through Pearson Ham, most of the downward movement for Q2 has been driven predominantly by April. So we've seen the big reduction in April, fairly flat in May, slightly up in June, and so far in July, things are remaining fairly flat, or if not slightly up. So we are tracking price movements on a daily basis. So we have this month seen kind of things remaining fairly constant and relatively flat. So where we are seeing those market predictions for price drops, I'm not so convinced by that. And I think things are going to remain relatively steady, and we may see some upward movements. I think where insurers had made price changes to reflect and respond to the environment that we're in, I think that they've now managed to kind of stabilize things. Operations are running relatively well from the kind of the new environment that we're in with home working. I think customer service levels are being achieved, and insurers from the previous charts that we've looked at have been able to open up and to start writing more of that business. We've also seen demand back in the market. So following a slight reduction at the beginning of lockdown, demand picked up again. So I think overall, business is relatively good for most of the motor insurers that I've been talking to over the past few weeks. So I don't think there's an urgent necessity for prices to reduce. There may be some tactical activity in terms of looking at changes in mix and driving behaviour and how that should be appropriately treated. So that's something that we look out for, but I wouldn't imagine that we would have any major price reductions coming through. So what do we see as medium and longer term impacts? So we have seen improvements in some sectors. So some of the motor sectors have seen peaks in demand. So in March, there were 66,000 light vans registered, which is a record month and over 10% higher than March last year. And this has also been reflected in the volume of quotations that we're seeing for vans coming through. So insurers that are big in the van market and have other lines of business may be enjoying some success there and be able to cross-subsidize some of the other areas through that. We're also seeing changes in driving behaviour, which may extend certainly into the medium and maybe into the longer term. So during the lockdown period, traffic was off the roads, essential journeys only, people working from home. As some of the restrictions have started to ease, then we've seen traffic returning to the roads. We are seeing that public transport is less attractive, so people are avoiding risks there and increasing the proportion of people commuting, and that's leading to more cars on the road. But also we're seeing people continuing to work from home, and that's reducing the total number of commuters that are out there. So the proportion of commuters driving may be up, but I think the overall volume of commuters is reducing, and that's something that we may see certainly now as some people are returning to their offices. Most people are continuing to work remotely, and I think depending on how effectively companies have been able to manage things remotely, then that might be something that impacts into the longer term. We're also moving into a period of recession following lockdown and the economic impacts of that. So we would expect to see kind of job cuts associated with that. So again, reducing the volume of people who would be commuting, reducing the volume of new vehicle purchases. So the types of mix changes that you would expect to see within a recession, I think, is something else that we have to be able to consider. Now, there is some historic evidence to go back to look at to determine how to assess that risk and how to price appropriately. So I think that's something that insurers need to be doing, is looking back to where we've seen similar periods of recession in the past. How does that impact and affect the mix, and how do we respond appropriately with pricing activities? So how have insurers responded? We from the insurers that we speak to, there tends to be a kind of a wait and see approach, which I think is a very natural approach in a situation like the one that we find ourselves in, where it's unprecedented. We've never been through a global pandemic before, and it's something that there's a lot of uncertainty around how this will impact on people's behaviour, how it's going to impact on business, how it's going to impact on risk, and what we should do in order to be able to overcome it. I think keeping calm and waiting and wait and see is a kind of a relatively safe approach, and it's something that wouldn't be surprising to see in the insurance industry. But I think there is also a risk of inaction. So we've seen quite a lot of activity within the market in terms of price movements for particular insurers who are able and more agile and can make those changes. I think there has to be a focus on maintaining your existing levels of service and managing your existing customers. And that means making sure that your renewal pricing is right, as well as the overall retention process. So optimizing that process to make sure that your customers are being well looked after and that they feel that you understand their challenges that they are having and are able to assist them with that. So there has to be a focus on that, because your customers are your competitors' new business targets. So it's essential to be able to provide those good levels of service and get your renewal pricing and processes right. In terms of acquisition, as I say, we've seen a lot of activity, and we've seen some insurers who are more agile than others. And I think it's those who have already invested in the people and the processes and the systems to be able to observe and monitor what's happening out there and to react and respond appropriately and quickly, that have been able to take advantage of some of the opportunities that have been presented and haven't been overcome by the challenges. And I think it's time for insurers who may be less able to do that to think about what it is within their own pricing processes, within the team, the tools that are being used, that could be improved to help and improve the agility and the ability to be able to observe, to determine what's happening, and to react and respond appropriately. So I think rather than waiting and seeing, we should be thinking about managing those existing customers, making sure they're getting a good service and that the pricing is right, and also thinking about what can be done in terms of improving your pricing capabilities and the function to be able to react and respond when necessary. Thank you. So that ends the presentation. So I'll take some questions now. I'll have a look through the chat and we'll respond to some of those. So we have one question. Do you think that coronavirus will have changed customer shopping around behaviour once we are back to normal? Is it becoming less reliable to assess demand using pre-COVID data observations? And how might this be adjusted for? I think we have seen quite a bit of change in terms of shopping around behaviour when people are doing it specifically. So as people move to remote working, we've seen the distribution of quotes becoming much more like weekends, so during the week. So some of the pricing approaches that have been taken for some of the more kind of retail focused insurers, there may be some rules in place which will be reflective of demand at certain times of the day, or other sort of time-based rules which may need to be reassessed. I think in terms of overall demand, there was a slight drop at the beginning of lockdown, which actually think demand is now back to the same previous levels, if not slightly higher in some areas, given that a large portion of the market is no longer running quotes. So thinking about the new drivers and younger drivers. So even with that portion of the quote mix removed, we are still seeing that demand there. So I think there will be changes in terms of driving behaviour and mix of business. So as I mentioned before, we need to think about looking at occupation. So if there are more redundancies and more unemployed people coming, if you're thinking about vehicle age and the kind of fewer newer vehicles on the market. So there are things that we can do to assess and react to differences in the mix. In terms of demand, I think there are kind of, when people are running quotes is changing, but the overall level of demand appears to be back where it is. Do you think that trends will return to normal, e.g. Jan, Feb levels for driving levels, claims, etc.? And if there are fewer drivers' claims, what impact will that have on insurers, brokers, business models? It's an interesting one, and I think that it will vary. And as I mentioned before, I think there will be a change which will be certainly medium and maybe longer term in terms of driving behaviour. So as more people are working from home, then there may be less commuters on the road. There's the kind of inevitable economic downturn implications of people losing their jobs and not buying new vehicles. And I think that again changes the behaviour and the drivers out there. I think this year certainly there will be more people taking holidays within the UK, so less foreign travel. And I think this is going to increase traffic in some of those holiday destination areas, and there will be an increased number of drivers who are unfamiliar with those roads. So there's the potential to a potentially increased risk through kind of an increased volume of those drivers in those types of destinations. We've obviously got the kind of the exposure that's been reduced over the lockdown period, has taken out some of the risk there. So I think we're still kind of waiting to see what we should be doing in reaction to that. Do we think we will see more people get rid of their vehicles and purchase bicycles? Will insurers begin to focus on bikes and compete with the likes of Laka, Bicmo, etc.? Yes, it's a good question, and it's something which obviously is being encouraged in terms of getting people to commute to work without using public transport. So I think it's more of those drivers who I think it's more aimed at people who would previously be taking public transport will be moving to those other forms. But I think we've seen a massive increase in the sale of bicycles, and we have seen insurers developing those propositions specifically to target those items. So I think, yeah, there's definitely something in that, and we've already seen a focus on some insurers who are accelerating plans to develop those specific propositions. Okay, so I think that's the end of our questions. So I'll bring things to a close. So this is the first of a series of 5 webinars that we're running on insurance pricing in 2 weeks' time, and it's focused on pricing reviews. So when you conduct a review of your pricing function and capabilities, what are the key things that you should be looking out for? So that'll be the next one in 2 weeks' time. It's the same day, same time, Wednesday, 1 o'clock in 2 weeks' time. So I hope you found this session informative, and I look forward to joining with you next time. Thanks very much. Bye.